I have a special guest today. I'd like to welcome Professor John Taylor, who co-authored a book coming out in April, Currencies, Capital, and Central Bank Balances. I'll be anxious to read it because central banks have a lot of clout. Professor John, thank you for joining me. Let's get right into it. First day of a two-day Fed meeting. We all suspect that we're going to hear a lot more about the balance sheet, not only the size, but maybe the composition. Short, medium, or long-term securities, why does it matter?
Well, I think the size is very important. They've been, as you know, gradually reducing the size in a pretty smooth way, actually. Don't think it's been disruptive, but it looks like they're going to remove that reduction by the end of the year, and the composition may move more towards short-term treasuries. I think, but it's going well. It's going well. I think some clarity about where they're going is going to be really helpful too, and hopefully we'll get that. Maybe not in this meeting, maybe the next meeting.
You know, many say that even though it's been subtle, that the Fed is going through an inflation rethink. I know that friend of CNBC, Peter Bookfar, says it's more of a cost of living adjustment than anything else. Do you have any thoughts? You know, one of the pillars, stable prices. Listen, John, we could look at these prices and argue if they're a little low or just right. But one thing we can't argue about, they have been awfully stable.
Yes, I think that's right. Well, what they're trying to do is they use the word normalize all the time. I think that is the right word to use. And as the economy's looked a little weaker, they've held off the so-called patience, but they're still stressing this data dependence. I like to think that the data dependence plus a little patience means a pretty good policy, maybe even a policy rule. And that means they don't adjust too much, too erratically, but are patient in how they make their adjustments. I think that's what's happening right now.
Now, to kind of dig in on what you just said, do you have a feeling that central bankers in general and ours specifically have gotten a lot more into the micromanagement business, especially after the crisis? You know, the fire's out of the credit crisis, but yet our central bank is still pretty active in kind of remodeling the economy, picking out the drapes in the rug. Do you think that this is too much? They'd be more of a nudging organization, John?
I do. I think it's too much, especially, as you mentioned, if you go globally. You know, you got the Bank of Japan buying private equity. You got the ECB until recently buying private securities. So that would be, by most definitions, a lot of micromanagement. The negative interest rates you're seeing in other parts of the world are the same kind of thing. I'd like to see the Fed getting back to a more market-based approach to interest rate setting, et cetera. It's kind of like they were before. This book you just mentioned, Peter Fisher, who used to run the trading desk in New York, has a lot of sensible things to say about this, and I think it's quite consistent with what you just said.
We have a little less than a minute left. Quickly, fallout from what I call OCP, other countries' policies, and you sort of hinted at it. You know, to me, one of the biggest questions as to the longevity of this expansion is how Europe and Japan and the UK, to some extent, deal with their lack of it through monetary policy. Your final thoughts?
You're so right. This is a global situation at this point. The European Central Bank, the Bank of Japan, the Bank of England, we're all in this together, and I think the Fed is, as a leader as it should be, needs to do this normalization in a good way. The other banks will follow, and I think we'll have a better situation. Let's cross our fingers. That's how it works out.